Should I pay points if I'm getting a mortgage today? So, question we just got asked from a borrower. He's getting a VA loan. So, I'm going to use some real world numbers here and this is real time. This is an actual loan that was priced out, and it'll show you a little bit behind the curtain about how lenders work. And hopefully, it will help you answer the question of, is paying points going to be the right thing for you to do in order to maximize the amount of money you have when making a purchase and minimize the amount of interest that you pay. I'm Don Harkins. This is the Don Harkins Real Estate Show. We help investors, lenders, real estate agents, home buyers, and home sellers navigate the complex world of real estate. We expose a lot of myths and misconceptions that large corporations use to try and generate business and clickbait. And hopefully, in listening or watching this, you'll come away as a more experienced and savvy real estate practitioner, or as a home buyer or seller, better equipped to navigate the market today as we see it in real time. So when we talk about points, I'm a mortgage broker, but whether you're a broker or a banker, you have a rate sheet when you are looking at mortgages and loans. So if a borrower walks into the bank and they're asking for a mortgage, you can give them a mortgage at a lot of different rates. A lot of people think, well, I applied for a mortgage and this was what my rate is. It's not really the case. Your rate can be a lot of different numbers depending on how the mortgage is structured. Not only different loan types, VA loans and FHA loans and conventional loans carry different rates, but the same borrower, the same house, the same loan amount can also have different rates. And I'm going to show you exactly how that works. Now, whether or not you are a broker or a banker, probably what you're doing is you're originating a loan, and a buyer is going to walk in or fill out an application and ask for money to purchase a house. You're going to collect all the documents, present different scenarios and options, get different interest rates, review documentation, pre-qualify the borrower, and then you're going to do the work of originating and funding that mortgage. And then ultimately that's going to get sold. That mortgage is going to get sold in what they call the secondary mortgage market to Fannie Mae. And there's a really interesting article that Fannie Mae put together called The Basics of Fannie Mae Single Family MBS. Here's a really high level overview of it. The borrower comes into the bank, gets a loan, 15, 30-year fixed rate adjustable, doesn't really matter. During the life of the loan, the balance is paid down. The borrower repays the loan in monthly installments that typically include both principal and interest. That's considered the primary mortgage market. So Fannie Mae goes on to say, as a secondary market participant in mortgage-backed securities, Fannie Mae does not lend directly to borrowers. So you hear people talk about Fannie Mae and Freddie Mac a lot. You might be wondering what they do. They're a government-sponsored enterprise chartered by Congress to provide, this is what Fannie Mae and Freddie Mac do. They provide liquidity, they increase stability, and they promote affordability in the residential mortgage market. Founded by Congress, or founded by a congressional charter passed in 1954, Fannie Mae allows these things to happen by charging a fee to guarantee the credit worthiness of certain mortgage loans that meet their requirements. So most of the time when we're saying, is the borrower qualified? Well, the question we're answering is, do they meet Fannie Mae or Freddie Mac requirements? If you're getting a VA loan, Ginnie Mae requirements. That's what we're doing when we're underwriting, is we're saying, do they meet the requirements set by Fannie Mae or Freddie Mac, who ultimately we're going to want to sell this mortgage to? Fannie Mae ensures that the loans it acquires meets its guidelines for credit quality and loan size, and then converts or securitizes them into a pool of mortgages. The resulting Fannie Mae mortgage-backed securities, MBS, they also call them agency MBS, carries a guarantee of timely payment of principal and interest to the investor by Fannie Mae, whether or not there is sufficient cash flow for the underlying group of mortgages. And so it goes on to say, to provide even more liquidity to the mortgage investment market, Fannie Mae began securitizing loans and issuing MBS, mortgage-backed securities, in the 1980s. Our participation in the mortgage market enables consumers to attain more favorable rates to buy homes, refinance existing mortgages, or access affordable rental housing. So that's the secondary market. And this is a 16-page report. It's a great overview of the secondary mortgage market, but ultimately that's what happens. Borrowers are coming in, they're getting cash from a lender. In exchange for that cash, they're giving the lender a mortgage. Lender turns around, sells that mortgage to Fannie Mae. Fannie Mae converts it to an MBS, gets cash back, and then Fannie Mae takes that cash and gives it back to the lender, so the lender can give it back to borrowers, and on and on and on and on and on. This is how the secondary mortgage market works. So how does all this have to do anything with whether or not you should be paying points for your mortgage today? Well, it all comes back to the rate sheet. And so this is it's real time. This is from an actual lender today. It's their published rate sheet. So it's not for any specific borrower. It's not for any specific credit score. It's not for any specific property type, because condos carry different rates than single family homes. Second homes carry different rates than primary homes. Homes in different parts of the country carry different rates. Different loan amounts carry different rates. So, let's not get bogged down into, are these my actual rates? These aren't your actual rates. This is just a published rate sheet. It's basically one particular lender today publishing a rate sheet saying, hey, here's where our line in the sand is. Here's where our rates are that we're offering people today. Come price a loan out with us and see if we're competitive for your borrower. So with this published rate sheet, you would think that, as the interest rate goes down, the cost of getting the lower rate would increase incrementally, right? These are all 1/8 of 1%, 7.5 to 3.75 to 2.50 to 7.125. So if the rate is moving down by 1/8 of a percent every time you go down the rate sheet, shouldn't the cost of acquiring that rate also incrementally and evenly move by 1/8 all the way down the rate sheet? But that very much doesn't happen. And there's a lot of discrepancies as you move up and down the rate sheet here. So this was based on a $700,000 loan amount. And when we talk about paying points, 1 point is 1% of the loan amount. So on a $700,000 loan, 1 point costs $7,000. So this rate right here, you can see a 6.875% rate. If you pay 1 point, this is essentially paying 1 point, then you'll be at a 6.875% loan amount on this rate sheet. Again, just for example, right? So a half a point is about $3,500. So this is paying about a half a point. 2 points is about $14,000. So this is paying about 2 points. So when lenders, originators, brokers, bankers talk about paying points or paying discount points, what they're talking about is paying a percentage of the loan amount in order to access a lower rate. So question comes up today from a borrower, should I be paying points? Well, the answer is, for most people right now, I'm finding anecdotally, the answer is yes. You probably should be paying points. How many points depends on your budget and your goals. But this is why I think for most people, you should pay some points, or you should consider paying points at least. You should at least review options. Different interest rates right now are on the secondary mortgage market that we just talked about. They're worth different amounts of money. And so conventional wisdom would lead you to believe that a loan with a higher interest rate would almost always be worth more money than a loan with a lower interest rate. right? A loan with a higher interest rate is going to receive more interest payment, more money in interest over the same exact time period, 30 years, as a loan with a lower interest rate. So a loan with a higher interest rate should always, you would think, be worth more money than a loan with a lower interest rate. But what we see with the rate sheet and with the different prices and different points required to access different interest rates, that's very much not the case. In fact, as you can see moving up and down a rate sheet, certain loans at a higher rate are actually worth less money to a lender and can actually be sold for less money on the secondary market. And the reason for this is that these loans carry a higher risk of refinancing early or a higher risk of sale. They offer the lender, they offer the investors, the MBS investors, and they offer Fannie Mae less value over the long run, because even though they're at a higher rate, that higher rate makes them more likely to be refinanced or sold out of in a shorter amount of time than loans at a lower rate. So, in order to entice bankers, originators, brokers, and lenders to originate loans which are likely to have more longevity and generate more interest payments, lenders will charge premiums on loans which have a high chance of being refinanced in a short amount of time or being sold in a short amount of time. And they'll offer discounts on rates that are likely to be in place for a longer period of time. So you look right here, and if you don't look up and down a rate sheet, and this is why it's so critical that you work with a mortgage broker or mortgage originator that has a lot of time in the business and understands how to look at many options, because you could easily be working with someone who says, okay, yeah, look, the rate is 7.5, but I can get you into 7.375. It's going to cost you $2,300 in points. And if you don't look at the full rate sheet, if you're not pricing it out and looking at different scenarios, you're not even going to see that, oh my gosh, for literally 1/3 of that, I could have a lower rate. Instead of having to pay $2,380 to get 7.375, I can pay 1/3 of that. I can pay just $840 and I can get to 7.250. But again, if you're not studying the full rate sheet, if you don't know how to look at the full rate sheet and price out all these scenarios, you're not even going to see, oh my gosh, for even less than that, I could get to 7.125. This is another mistake people make. A borrower calls up and says, well, I don't want to be above 7. 7%. If you can get me in at 7%, that's the rate I want. I don't want to pay above 7%. You say, hey, fantastic. I priced out a loan. I ran the application. I looked. I can get you a 7% interest rate. It's going to cost $3,800 in this particular example. Not studying the rate sheet, not knowing how to price out different scenarios, not looking at all your options, you're going to miss that, oh my gosh, I know you wanted 7%, Mr. Borrower, but guess what? 7% is going to cost $3,800. I can get you into 6.75% and I can save you $1,000. Instead of having to pay a half a point, you can pay almost 1/3 of a point and get all the way down to 6.75. But again, that extra option, looking at the full spread, lenders are saying here, hey, look, 6.625, you're likely to be in that loan a little bit longer. We're only $500 more. We'll give you that extra 0.1%. So that borrower calls up and says, hey, if you can get me a rate at 7%, my cash to close stays at this. I'm in. I'll take that. Well, look, for $600 less, I can get you in at 6.625%. Critical to know how to do this. And as a buyer, you're looking at your cash to close. You're looking at your monthly payment. You're looking at your debt to income ratio. You're looking at how long you expect to own the home. All these things factor in as to where on this sheet you might wind up being. But pretty remarkable to see here, 6.5% is basically the same price as 6.875%, 6.625%, basically the same price as 7.00. And look, it's going to be different for every borrower. Where exactly should you be? How much should you buy down? What we know right now is buyers surveyed in 2024 said they expected to be in their home for 15 years. Sellers who sold in 2024 were actually in their homes on average for 10 years. Historically, we've seen data that shows that most people move once every 7 to 10 years. It's possible that with these lower interest rates, even probable with the lower interest rates people have, we're going to see that number skew up and people will remain in their homes longer, the higher end of that. If you're going to be in your home for a long time, then that's great. You have a lot of time to recoup the money that you paid to buy points. But things happen. Had another kid. Someone got laid off. Someone passed away. Someone got transferred. Have a grandkid now. Don't like who just got elected in my area. Neighbors, an a-hole. All these things come up where people thought they were going to be in their home for 10, 15 years, and boom, all of a sudden, 3 years later, they're selling. 5 years later, they're selling. So it would be wise to not put yourself into a mortgage that you had to be in for 5 or 6 years before you broke even on the amount of points you paid and actually started to get some savings out of that. Let me show you what I'm talking about with breaking even, and I'll use another loan scenario here. This particular loan, this was also a VA loan. And you can see here the interest rates. This is one borrower. Purchase price is the same, right? Purchase price doesn't change. Loan amount changes a little bit based on the scenario. Interest rate changes, right? So cash to close changes. We got $13,000 to close, $26,000 to close, or $47,000 to close. And monthly payment changes. So when we're talking about paying points with this particular loan right here, they decided not to go with this option, and we were really considering these two options. And the big differentiator was going to be 6.390 or a 5.750. And what's the implication there on a payment standpoint? Well, it's $250 a month, basically, right? Pay points, save $250 a month. Well, saving $250 sounds pretty good. Why the heck wouldn't I do that? Well, you can see here, it doubles your cash to close. So if you have the money, doubles your cash to close, but you say, hey, I got 26 grand, that's no problem. Then isn't it a no-brainer to save $250 and pay the points? Well, going back to what we were talking about with our time to recoup, this is our points right here. So the first loan on that first screen, 0 points. The second loan, $13,700 in points. So it's going to cost us $13,700 to save $250 a month. $13,700 to save $250 a month, right? $3,000 a year. At $4,000, at 4 years, you're at $12,000. 4.5 years, roughly somewhere in there, 4.25 years. Now you've recouped in monthly savings the cost of those points. So year 5, you keep the house 5 years. Year 5, hey, I paid 13 grand. Now it's year 5. What's my return on investment for 13 grand? Well, on year 5, my return on investment is 3 grand. Year 6, return on investment 6. Year 7, return on investment 9. Year 8, return on investment 12. It's 100% ROI. As long as I keep it that long over the life of a loan, you can see savings over 180 months, $41,000. I mean, that's meaningful over 15 years. It's meaningful savings. But again, 2.5 years, 3 years go by. You say, uh-oh, my situation's changed. Problem came up, got to move. Now I'm just 2.5, 3 years in. I've recouped 9 grand of my points back, but I've got 13,000 that I laid out there. So I turn around, I have to sell. That $4,000 is gone. You don't get that money back. Doesn't go with you. It doesn't get refunded. It's paid up front in full at the time of closing. Now, 2 great things about points. Well, there's a lot of things to like about points. Number one, makes the house more affordable, right? Lower monthly payment. Number two, you pay less interest over time. So not only does it save me money today, but it saves me money in real terms over the long run. I pay less interest. The other thing that's nice about points is they're tax deductible. So in the year that you pay the points, you can write those points off. The other thing that's nice about points is they can be paid by the seller as a closing cost credit. Now, if the seller pays the points, then the seller is the one that is able to write those points off. Check with your tax advisor, right? I'm not a CPA here, not a tax expert by any means, but points are deductible. Other thing is, as a buyer, again, like get with a broker, get with an agent, a real estate agent who understands these nuances. You could ask a seller, hey, seller, could you pay 2 points for my mortgage so I can get that super low rate? The example we just went over, 2 points. If you get a seller to pay 2 points on this loan, well, heck, that's getting you all the way down to 6%. What a deal. It doesn't even cost you anything. The seller's paying for it. Seller pays 2 points towards my mortgage buy down. I get a super low rate. Fantastic. Well, what if instead you ask the seller, hey, could you give me a 2% closing cost credit? And then you pay the points. So now you're getting the write-off and you're getting the benefit of the lower rate. So nuances in how you structure a deal in this market compounded over time, right? If you're being efficient at the rate sheet, picking the right amount of points, the right size loan, you're structuring your offer wisely, working with a skilled broker, and then you're being strategic with your tax advisor, making all the right decisions throughout the transaction can have massive implications at the end of the year when you look back and see how effective and efficient was I in structuring the lowest cost purchase, the lowest cost mortgage that I possibly could. I hope that's helpful in giving you a high level overview about points, whether you should pay them, when you should pay them, how much they cost. It's different for every single borrower. So there's no one size fits all here. That's just a high level theory look. The dashboard that I showed you, we can create that dashboard for every borrower in every loan type you can imagine. We can line up 4 loans side by side. We can look at all sorts of different closing costs, all sorts of different cash to close amounts, all sorts of different monthly payments. We can extrapolate that out over 15 and 30 years and see what the total cost of those different strategies and the total savings of those different strategies are to help you make sure that you are absolutely being as efficient as possible with your financing. And then once we have a good strategy in place, we know, okay, this is what our mortgage strategy is going to be. We can go reverse engineer that and say, how do we structure a purchase offer with a home seller or representing a buyer? How do we go to a home seller and structure an offer that maximizes our efficiency with our financing? And this isn't just for buyers. This is not just for borrowers, buyers, and real estate agents. If you're a home seller and you are struggling to generate offers on your home because your home is unaffordable because of where rates and prices are, absolutely make sure that your listing agent is presenting options to buyers. Or a buyer comes in, they say, hey, I want $25,000 off the price. With this particular loan, $25,000 off the price, that's going to save you about $180 a month. $25,000 is going to save you about $180 a month in price reduction. $25,000 in points is going to save you hundreds and hundreds of dollars a month. So as a seller interviewing agents looking for a listing agent, be sure that you're being flexible and creative with how you're countering offers that come in from buyers, because buyers don't necessarily know this stuff. Buyers, lenders don't necessarily know this stuff. Use these strategies to make your home more affordable on the marketplace and leave your neighbors saying, man, how did they get that price for their house? I'm over here reducing my price. My neighbor just sold at a 5% premium. How did they do it? Use these strategies, educate the buyers that come through your listings or come through your home if your home is for sale, and use that to create affordable purchase opportunities in a time where we absolutely need it. Rents are high, prices are high, rates are high. If If you have any questions, I'm Don Harkins. I have a property management company called Sea Dog Property Management where we do long-term property management, full service for investors that own residential homes and really just want a hands-off experience with a statement at the end of the month every month, really clean and easy. We also do traditional sales and traditional listings with real estate, both in Central Florida at our office and in our office on the Space Coast. And then I also run Don Harkins Mortgage Team, where we do all the things we talked about today for mortgage buyers, even for sellers. If you're a seller or a listing agent, reach out to me. We can give you some hints and tips about how to apply this stuff on your current active listings or your for sale by owner properties. But any real estate questions you have, please reach out to me. You can reach me at Don Harkins, don@donharkinsrealty.com, or you can call me at 321-377-0341. Thanks, and be sure to like and subscribe. Leave us a review if you're listening online or a podcast. Drop a comment if you have any questions about your own scenario, and have a great day.